Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In Leading Professional Service Firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Jed Ellerbroek of Argent Capital Management. Jed has over 20 years of investment industry experience and is a portfolio manager for the Argent Large Cap Strategy. Before joining Argent, he spent over a decade at PNC Capital Advisors. Argent has approximately $3.5 billion under management. Jed, welcome to today's podcast.
Thanks for having me.
Jed, as we meet today, obviously a very dynamic investment environment with geopolitical tensions sort of driving the narrative. How do you approach a market like that with this type of backdrop?
Yeah, I mean, today I feel like the primary thing impacting stock market movements day to day is the Iran war and oil prices. Prior to that, I think it was, really heavily based on AI and the unprecedented nature of its diffusion in our economy. And there, that is happening so rapidly that it's unprecedented, and makes it obviously much more difficult to kind of price in individual companies. So yeah, I feel like investors have gotten a really good education investing in markets dominated by kind of big macro factors, big macro environments these last couple of years. Argent's investment philosophy is very much bottom up. We're researching individual companies. We're comparing their products to their peers. We're evaluating their negotiating leverage versus, customers and suppliers, management's capital allocation, et cetera. So there is some, kind of some feeling of discordance there. We believe that at the end of the day, stock prices are impacted by, companies' valuations, by their growth prospects, by their return on invested capital, and by their capital allocation. And so we think that the kind of basic tenets of our investment philosophy remain relevant and important. But in certain months, even certain years, that varies, based on the market's time horizon. And there's no doubt that investors' time horizons have shortened over the last, decade.
And you've, given the tenure of your investment experience, you've obviously been through several market cycles in your career, each one distinct on their own, probably. Are there any sort of generally takeaway observations from that experience?
Over the last 20 years, I think my kind of most important takeaway is that the valuation premium that the highest quality companies get in the market has expanded. Um, and I say that having experienced the last 12 months where I think that those kind of quality spreads have declined. We've seen a reversal of that over the last 12 months. But I think over the last 10, 20 years, I think we've seen the highest quality companies outperform. And I think we've seen the returns on competitive advantage expand. And I think that the number one reason for that is as our economy becomes more technology and data based, markets, the technology markets, tend to be winner take most, winner take all type markets. And I think we're seeing that kind of behavior seeping into less, not traditional technology industries. One that comes to mind is the banking industry, where a company like JP Morgan, the biggest, most sophisticated, most profitable, really embracing technology, spending a huge chunk of their expense base on technology to improve their products, and customers responding to that, and market share over time moving to JP Morgan. And that's just one example. You can find examples of that across almost every sector, where like kind of big is winning, the most sophisticated is winning, the biggest technology adopter is winning. And so I think that's probably the single biggest thing that I've experienced and observed over the last 20 years.
And shifting into the discovery process, large cap, generally well-known names. Is it screening tools, sector trends, interaction with management teams? What drives the identification process for a good idea?
Yeah, I like to find companies where there's something investors are concerned about or worried about today that I don't think is going to be dictating stock price movements 5 years from now. And obviously that varies greatly, but oftentimes you see those stocks valuations come down and become more reasonable. And I like to buy really high quality growth companies when they are reasonably valued because of some near term concern or threat. And this is a target rich environment right now for those types of companies with all of the AI fear and uncertainty in the market today.
And you mentioned sort of bottom up, but what about the macro? I mentioned at the top of the podcast, geopolitical. We've got interest rates, the Fed, labor markets. What are you focusing on, and how do you think about the macro right now?
Yeah, we try to structure the portfolio in a way that it's balanced and diversified and has exposure to most, not all, but most sectors of our stock market, while maintaining that kind of best ideas, concentrated, low turnover portfolio. So that's a balancing act, of course. Um, we try to be like we try to be in the ballpark of neutrally positioned against macro factors that we don't control and investors historically have done a really bad job predicting or anticipating. And so interest rate exposure, for example, we don't want to have the portfolio really tilted one way or the other. Predicting interest rates is really, really difficult, not something we spend a great deal of time on. And so try to kind of neutralize that to the extent possible. Similar kind of philosophy with commodities and oil prices. We own a token energy company or two to give us exposure. We try to have that one or two companies be kind of high quality compounder type businesses. But we don't want to expose our investors to a lot of macro factors that we don't spend a lot of time thinking about and haven't done a great job historically predicting.
And Jed, shifting into themes, you touched on AI, technology. Are there other ones that you find particularly compelling right now that are sort of driving your investing approach or what's in the portfolio?
Yeah, aerospace and defense is an area that we have interest in, that investors, have interest in those stocks. There are a lot of outstanding businesses in aerospace and defense. Um, there's a lot of competitive, advantage and moats in that area, and demand is strong and growing both, on the original equipment side and also aftermarket. So across all of Argent strategies, we have exposure to aerospace and defense and really like a lot of those businesses. Think the growth outlook is good, will be for a long time, and think there are a lot of really outstanding management teams and capital allocators in that industry. So for us, that means TransDigm large cap, a business like Heiko in mid cap.
And moving further into portfolio construction, you've mentioned capital allocation a few times. From an idea generation perspective, can you share with us what specific quantitative or qualitative factors stand out to you when you're constructing the investment mosaic?
Yeah, we try to think of ourselves as partnering with the companies we own. That's that long-term philosophy coming through. Our average holding period is in excess of 5 years for most of our strategies. So we think of it as like a through the cycle partnership with the management teams and companies that we've invested in. We want to see from those management teams a track record of capital allocation that is shareholder friendly. And obviously there's a different prescription for each business in that regard. Some businesses are best paying out a lot of their profits as dividends to shareholders because they don't have compelling high ROI growth opportunities. Others should be plowing every dollar they can into building new data centers or R&D perhaps. So the prescription is different for every business, but we like it when we find management teams that are allocating capital in the way that we would after reviewing the business. So kind of their philosophy and orientation to the business, their view of the outlook kind of lines up with ours. And so that alignment is really important to us. We're not worried so much about management's words, but more so their prior actions.
And, from a company perspective, how do you distinguish between one that has a significant, sustainable, competitive advantage and durable growth versus one that's simply sort of riding a trend? What stands out?
Sustained high return on invested capital is probably the starting point for us. From there, we do deep dive research to try to really understand the business, the nature of its competitive advantage, and then we try to analyze or project forward what might challenge that, what threats there are to that, and then we try to assess each of those, and then keep a close eye on them going forward. And so it's a very qualitative analysis with the initial kind of quantitative view being like an ROIC type metric. Also, high profit margins is a good starting point as well.
And so if a company's competitive advantage is strengthening or eroding over time, you would see it through margins, you would say, and return on capital. Those are the two key metrics.
Yeah, and also, an eroding competitive advantage oftentimes also shows up in slowing revenue growth too. Or revenues growing slower than peers. Or another one is a kind of a hot new venture capital backed startup, attacking that industry from like kind of an adjacent angle. You see quite often as well.
And valuation, I mean, what stands out? What makes a valuation attractive to Argent?
Yeah, if we are trying to build a portfolio filled with kind of quality compounders, um, you don't get something without having to give up something else in the stock market. And so, we want to pay reasonable and attractive prices for the businesses we buy, but you don't often find them heavily discounted, businesses of that high quality. So we're trying to find companies that trade below their kind of historical average valuations. We want to find reasonably priced, great businesses. I think that's a good formula. Of course, we'd love it if they were deeply discounted too, but you don't get those opportunities as frequently as we would like. Um, so yeah, typically, if we can buy a great business for a market multiple, that's appealing.
And Jed, Argent emphasizes a cash flow approach in its investing. What metrics or signals give you confidence that cash flow growth will persist over long time horizons?
Yeah, I think the nature of the company's business model and their revenue generation, I think, is probably the first place I would look for that. you know, Consumption revenues. The company's revenues representing, a, a cost of goods sold item, not, a capital expenditure is a good place to start with that. So Nvidia, for example, and we own Nvidia in our large cap strategy. All of the revenues they generate are capital expenditures for their customers. Capital expenditures are more volatile than cost of goods sold expenses. So I think there's like a natural volatility to NVIDIA's revenues. But I think the argument that an investor who owns NVIDIA would make is the chips that NVIDIA makes enable revenue generation, and that 5 or 6 year life of the chip is far shorter than many of the other products that go into building a data center. And as this as our economy becomes more about technology and data, NVIDIA's chips become more and more essential, and they are kind of converting from they're converting to kind of a lesser version of CapEx, something you need to replace every couple of years and not once a decade. So kind of that like shift, the incremental shift.
And now a word from our sponsor. If you work in a financial services firm, this program could be worth a look for you or someone on your leadership team. Harvard Business School offers an executive education program called Leading Professional Service Firms, a 5-day in-person experience held on their campus in Boston. The program is built around real-world examples and is designed for senior leaders dealing with the day-to-day realities of professional service organizations, setting strategy, developing talent, and managing client relationships. You'll spend time working through real company challenges, looking at how firms align partners, build culture, and continue to grow in competitive markets. To learn more, visit hbs.me/client. That's hbs.me/client. And we discussed capital allocation, cash flow, getting deeper into that, things like share repurchases. Under what circumstances is that a better investment than a company redeploying capital internally, or is it more about striking a balance?
Yeah, not all companies have internal growth opportunities that are high return on invested capital. And MasterCard is an example of a business that we own in large cap. It's a great business. They have growth opportunities. They make kind of small, more technology-based acquisitions, but they're usually smaller. And so they generate excess cash flow beyond the needs to, sustain their business and even grow. And so in that circumstance, I think share repurchase makes sense. They're buying back their shares, which have performed well over time. The valuation today is attractive. Um, I think just a hair above, 20 times earnings, if I'm remembering correct, which is cheaper than normal. And that stock is really out of favor because investors are worried that stable coins, crypto, um, AI even will kind of change the nature of their customers' usage behaviors and payment patterns going forward. And I think the business is going to prove far more durable than that, and the management team agrees. And so they've stepped up share repurchases recently, which I think is a good idea.
And is there a point with share buybacks that they potentially impede value versus creating it? Do you see that sometimes?
Yeah, that like kind of value trap scenario does happen. If you're if the business in question is not growing, does not have high return on invested capital growth opportunities, has like kind of competitive intensity in their industry issues, if their customers are consolidating faster than their industry is, that oftentimes creates, a value trap environment where the company's prospects are deteriorating as they're buying back the stock, and those share repurchases never add value for shareholders. And in that case, shareholders would be better off receiving dividends.
And what about things like insider buying? Is that a signal to you? Is that constructive in your mind when you're looking at a company?
Yeah, yeah, absolutely. I talked about, mentioned the kind of partnership mentality, seeing one of your partners who knows more about the business and the day-to-day goings on than you do, seeing them step up and buy shares, that's a really important and positive signal. And those management team executives own a lot of stock to begin with. They have stock options. They've got plenty of exposure to the stock. Their income is based on the success of that company. So, to see them, make an insider purchase like that, that is a big signal and something we pay a lot of attention to, and helps to, us build conviction in stocks that we really like and are committed to. But when you see that stock, struggling, underperforming, over a several month period or even longer than that, seeing insider purchases is a conviction enhancing thing for sure.
And shifting into portfolio construction, you've touched on aerospace and defense and some other, financial service sectors. Are there other sectors that you view favorably in the current environment and you find compelling?
Yeah, technology, I think. The technology sector is out of favor today. And I think investors are really concerned about the impact of AI. I think there's kind of a shoot first, ask questions later type approach with technology at the moment. And we've seen a lot of really, really high quality, stable, strong businesses in the technology sector perform really poorly for quite some time. And first one that comes to mind for me right now is Microsoft. Microsoft is down to 20 times earnings. For a while there, it was outperforming software stocks that were going down every day. But at this point, that's not really true. It's performing just about as poorly as every other software stock. And it's getting very limited credit for its cloud computing Azure business. And I think it's getting very little credit for the kind of durable, sticky nature of its software products in the enterprise environment. So I think that's a stock that is attractively valued today. I think investors are feel great uncertainty and fear about the impact of AI and the negative aspects it might have on existing businesses that are deeply entrenched in enterprise workflows. And so, that's a situation that intrigues us today. And I think that there are many examples of that in technology. And I guess I'm defining technology broadly. Amazon is another one. It's technically a consumer discretionary stock, but boy, that's a stock that I really like today and think is attractively priced.
And you're also going through some kind of, we had so much sector concentration. You mentioned technology. Are we just going through an unwind period, a little bit of that sort of philosophy? And what do you think people could be rotating into to get to move away from that?
Yeah, we have seen a big rotation. The tech stocks led the large cap equity markets in the US here for a decade. That switched, pretty dramatically, in the spring of last year. And just year to date, the value stocks are up about 10%, growth stocks are down a couple percent. So big outperformance by those previously out of favor, more value oriented type stocks. We've seen energy perform really well. We've seen industrial companies start to perform well. um, and we've seen utilities do really well too. So yeah, we've seen a big rotation. Will that continue? I mean, yeah, I think that's the biggest question facing investors today. At what point do these technology valuations bottom? And at a sector level, there are great AI fears, and then there are stocks that are doing very well because of basically AI capex enthusiasm. And so I think looking out years, it's hard to envision those AI capex beneficiaries doing extremely well without the rest of the sector joining in and participating as well.
And sectors to underweight, are there ones that you're avoiding today?
Yeah, we are underweight healthcare, have been for a little while. That sector's really struggled for years. Many parts of healthcare did very well in the aftermath of COVID as drug research, expanded greatly, and there was a lot of enthusiasm for that. That boom led to a pretty severe hangover for a lot of life science tools companies and drug companies, and that sector's just continued to lag. So we are underweight healthcare. That has benefited our performance over the last couple of years for most of our strategies. Valuations are reasonably low today in healthcare. But even just since the U.S.-Iran war started, I think you would have expected healthcare to be a more defensive sector, but it hasn't performed as well as you would have hoped and expected.
And Jed, as you approach portfolio construction differently, I mean, do you approach portfolio construction differently during periods of heightened volatility? You mentioned it's sort of target rich and market stress like we're experiencing now. Does that create sort of additional buying opportunities to sort of add to new names or adjust existing positions?
Yeah, we try to think about portfolio construction in a consistent manner over time. I think that's important. I think it's important to have a philosophy and strategy that you implement consistently over time through cycles. Parts of those cycles there will be a lot of tumult in markets as we see today. But that consistency of approach and strategy and portfolio construction, I think, is really important. That said, like you alluded to, there are a lot of opportunities in markets today. There are a lot of sectors and industries that have been out of favor for some time and valuations are attractive. There are also sectors that have done very, very well. So I think trimming something like, energy stocks, which are riding high at the moment. Exxon trades north of 20 times earnings. That's more than the Microsoft 20 times earnings I cited a couple minutes ago. That's pretty interesting. You haven't gotten the opportunity to trade out of Exxon and into Microsoft and reduce the valuation very many times in the last 2 decades.
And you mentioned it before a little bit, market perception versus reality. What's the thinking or process you go through when you see a position on a stock that's not currently working out on a price performance basis, but you think the thesis is intact? Basically, how do you approach that?
We try to really anchor our analysis and our decision making on the fundamentals. That said, the market is usually right, and you want to respect the wisdom of the crowd. So when a stock that we own underperforms materially, and we struggle to understand isn't the right word, but kind of rationalize the company's financial results, the growth opportunities that we see with the stock price. When we feel that disconnect there, that causes us to kind of double back and reassess and try to take a fresh look at our investment thesis for that particular company, to question our assumptions and beliefs, and and kind of reappraise our exposure and what we want to do going forward. So sometimes that does lead us to reevaluate and sell stocks after a period of underperformance. Other times we kind of put a foot in the ground and hold our ground, or even add to the position. So yeah, those are, I think, some of the tougher decisions a portfolio manager faces managing a portfolio, especially when a bunch of them kind of emerge at the same time, and you kind of observe that multiple of your companies are exposed to this one new emerging thing that you didn't exactly expect.
And it touches also on taking profits. How do you decide in a stock to take profits? Because you do have a longer time horizon.
Our bias at Argent Capital is to let our winners run. That's kind of our starting point. You asked at the start of this discussion about kind of biggest learnings from my career, and I talked about kind of biggest winning dynamics emerging and quality stocks outperforming. The number two answer I would provide would be um, letting your winners run is a good idea, and trimming your losers as quick as you can identify them is the other side of that coin. Um, so that's our starting point, letting our winners run. But obviously, there's a limit to everything, and there's an exception to every rule. So we do trim outperforming winning stocks occasionally. We try to, we pay very close attention to valuations for all of our companies. When they reach, kind of one standard deviation or two standard deviations above normal, we oftentimes do trim those stocks back in order to allocate to something that we think is kind of a better idea at the time. We did that recently with Applied Materials, a semi-cap equipment company. There's a lot of enthusiasm today regarding that company and their prospects, mostly tied to this memory shortage. And the stock basically, doubled over a 6 or 8 month period here most recently. We trimmed our position in half. That's been a very good performer for our large cap strategy, but the valuation reached an all-time high. I think there's an argument to be made that we trimmed it too soon. We trimmed it basically when the positive estimate revision cycle has, just gotten started in the last couple of months. I think typically an investor would say, "Man, that's too soon to trim a stock. Like let this play out a little bit more." The upside surprises are going to continue, but semiconductor stocks have been moving so dramatically over the last few years, and Applied Materials valuation reached a point that I thought it was just a good idea to reduce our exposure, and also it was one of the largest positions in our strategy. So position sizing comes into play there when we're making that decision as well. If Applied Materials had been a 2% position, probably would have been more patient than when it was 6%.
And the portfolio is somewhat concentrated in the sense that there's a limited number of names in there, right? 30, 35
Yeah,
names in there at any given time.
yeah,
And on the one hand, it means they're high conviction names. You know what you own. On
yeah.
the other, how do you risk manage when it's that number of names?
Yeah, we try to have a broadly diversified portfolio. We try not to crowd into certain themes excessively. Um, that's a problem I've run into it in my career. I remember 2016 was a year in particular where I was working on a small cap strategy at the time, and we owned a couple RV companies that had a lot of exposure to the RV industry, recreational vehicles, and Trump's tariffs in his first term really threw a wrench in that industry for about a year and a half. So we do try to not overcrowd into our favorite themes. We try to maintain broad exposure. We try to um, have, we hew reasonably closely to the S&P 500 sector weights. That's not a religion for us, but we try to stay one or two trades away from the benchmark weights. And we do that just to ensure the proper diversification and balance in a portfolio, because we know that is a, 30 stock portfolio. That's a high conviction approach. Um, we also want to be broadly diversified and balanced, because one thing I know I'm not good at is at the start of the year predicting which sector is going to be the best performer and which one's going to be the worst. We don't want to play a sector allocation game. We want to play a stock picking game.
And lastly, we've covered several topics from process to construction to navigating market uncertainty. In summary, for a large cap, what would be, in your mind, the 2026 investment playbook? What would that look like?
I think that accelerated computing and all of the new artificial intelligence enabled tools is the most important theme, event, development impacting markets. It has been superseded at the moment by the US-Iran war. And prior to that, it's been, I think, kind of overshadowed by this, the tariff announcement and then kind of partial step back that occurred in May, and the junk rally that it catapulted. But AI to me is, I think, the most important event impacting our economy and our stock market over the next decade. And so I think having, kind of some firm convictions about which businesses and which industries and which sectors and which types of companies will benefit from all the new technology tools that are becoming available is a really important thing. And not doing that, I think, forms a blind spot for investors that can be pretty dangerous. So that's where my mind goes to that question. And then I guess secondarily, maintaining that broad diversification and balance, I think, is also important because at the end of the day, AI is very fast roll out into our economy and our lives and our work activities. It is unprecedented. And so that inherently is difficult to predict, in exacting detail.
Jed, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In leading professional service firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client.